Hello everyone, we are Group 2, and our group member is Li Guojun, Bai Junrui, He Weixuan, Zhang Jibo, Guo Ziyi. In today's interconnected world, money and information traverse borders at lightning speed, bridging both promise and peril for emerging economies. Turkey stands out as a vivid example of this duality. At the end of October 2022, its headline inflation scored to 85%. Well, between 2021 and 2022, the Turkish lira lost nearly 45% of its value against the US dollar. These stark figures illustrate a self-reinforcing cycle. A weakening currency drives up import costs, pushing domestic price higher, which in turn further undermines confidence in the lira. In this presentation, we will explore 5 key drivers of this cycle: innovative cross-border fintech flows, geopolitical tensions that reshape reserve strategies, climate-driven food shocks, swingings in foreign direct investment, and disruptions in global supply chains. And consider practical measures that Turkey and other emerging economies can adopt to slow unwanted volatility and restore stability. Let's turn to the first part: fintech cross-border flows and foreign exchange stability. In recent years, Turkey has witnessed the rapid rise in digital finance platforms and cryptocurrency on-ramps, enabling individuals and institutions to transfer large sums in or out of the country within seconds. By mid-2023, crypto gateways in Turkey were facilitating over $5 billion of transactions each month. These real-time flows, however, can bypass traditional central bank oversight and upend the carefully calibrated effects of interest rate decisions. A single social media post hinting at the change in policy can trigger a flood of inflows that pushes the lira up by as much as 2% in a few hours, only to be followed by sudden reversal when speculative traders upload positions. Such flash flow episodes blur the line between fundamental drivers and noise, making it difficult for policymakers to anchor inflation expectations or rely on the predictable lag between rate adjustments and economic outcomes. A sustainable response requires embedding real-time data tracking into the policy toolkit by developing simple dashboards that flag large cryptocurrency transfers and pairing these alerts with conventional exchange rate monitoring. The central bank can identify abnormal flow patterns early. When flow breach agree threshold, limited and transparent market interventions such as small-scale foreign exchange purchases or sales can be undertaken to absorb excessive volatility. At the same time, adjusting reserve requirements dynamically in response to abnormal crypto-linked deposits help maintain adequate liquidity buffers. This data-driven, rule-based framework reduces the need for surprise rates moves and reinforces the credibility of monetary policy in a world where capital can dash across borders in the blink of an eye. And now let's turn to the next part to Guo Ziyi.
Geopolitical tension and reserve management. Turkey's unique geopolitical position, straight in Europe, the Middle East, and Central Asia, exposed it to shifting alliance and sanction risks. In 2022, the Central Bank of the Republic of Turkey rebalanced its foreign exchange portfolio by increasing gold holdings from 380 to 450 tons while reducing US dollars reserve by $30 billion. This move aimed to shield reserve from potential dollar-dominated freeze or restrictive measures. Yet, diversifying into gold, euros, and renminbi also brings fresh challenges. During global dollar squeeze, gold can lose some liquidity premium, and non-dollar currency markets may not always be deep enough to support swift intervention. To manage this trade-off, transparency and stress testing are essential. Publishing a clear reserve policy that outlines the target range for each asset category, along with annual stress scenarios stimulating sudden dollar shortage or good market distribution helps occur market expansion. Regular, simplified reports detailing reserve allocation and performance under various hypothetical shocks reserve investor and banks that reserve management follow a predictable, rule-based strategy rather than at a whole political decision. In turn, this builds confidence in the central bank's ability to use its buffers efficiently, reducing speculative pressure on the lira during period of geopolitical uncertainty. Okay, let's turn to the next part to Zhang Jibo.
Now let's turn to part 3, climate-driven food shocks and inflation. Climate extremes are no longer distant corners. They directly influence macroeconomic stability. In 2021, several droughts in southeastern Turkey inflicted over $2 billion in agricultural losses and drove food price inflation to 45%. As food costs surge, headline inflation rises, real interest rates turn negative, and foreign investors withdraw from lira-denominated assets. This cycle further weakens the currency and perpetuates higher import price pressures. Integrating simple climate indicators into inflation forecasting can break this cycle. Soil moisture deficits, satellite-driven vegetation index, and rainfall anomalies should be flagged alongside traditional price measures. When a drought alarm is issued, physical authority can rapidly deploy index-linked crop insurance payout and ensure that farmers receive compensation within weeks, gathering rural income and preventing panic harvesting or distress sales. Parallel investments in small-scale irrigation and water management infrastructure build long-term resilience, reducing the frequency and the severity of crop failures. As food price volatility diminishes, overall inflation expectations become more stable, holding the monetary frameworks even as weather partners grow more electric. Okay, now let's turn to next part from He Weixuan.
Let me continue to introduce foreign direct investments in forex fluctuation and exchange rate stability. First, foreign direct investment traditionally provides stable, long-term capital in environments of policy. Essentially, it can become a source of volatility. Between 2021 and 2022, foreign direct investments inflows into Turkey fell from $80 billion to $40 billion, and further declined to esteemed $30 billion in 2023. Political developments, progressive central bank interference, and unorthodox rates cut during inflationary episodes have eroded investor confidence. As foreign direct investment inflows wane, the current account deficit widens, reaching 5.5% of GDP by 2020. Placing downward pressures on lira to mitigate these risks, it is essential to maintain a predictable regulatory environment, uphold central bank independence, and offer hedging instruments such as long-date foreign exchange rates, options, and swap lines. To investors, clear regular communication about upcoming reforms, including timelines for key projects and policy changes, help investors plan with confidence, providing incentive packages, promoting special economic zones, and investing in work-focused training programs can further reassure investors of a stable, supportive environment. Additionally, structural reforms that improve infrastructure, strengthen the rule of law, and reduce bureaucratic burden will enhance Turkey's appeal as a destination for sustainable foreign direct investments. Let's turn to the next part for Beijing Wei.
So the next part is about global supply chain disruptions and inflation pattern. So During this issue, the global supply chains remain vulnerable to shocks, from pandemic lockdowns to export restrictions and shipping delays. In 2022, the Turkey imported $230 billion of intermediate goods. And those disruptions drove the producer price inflation close to 120%. Research shows that in emerging markets, a 10% lira depression can translate into a further 1.5 to 2 percentage points of consumer price inflation within the 3 months. So, this high pass-through means that the exchange rate swings directly feed domestic price pressures. So, mitigating these effects calls for the supply chain diversification and the sensible buffer management. By securing the alternative sources for the critical inputs, Turkish manufacturers reduce their dependence on any single country or corridor. Building strategic stockpiles of essential materials cautions short-term shocks. Meanwhile, targeted production subsidies for the most affected sectors, such as automotive components or electronic assembly, can blunt the immediate impact on consumer prices. Arranging the swap lines with partner central banks ensuring that when the external financing dries up, the supply of foreign currency remains uninterrupted. So, together, these measures temper cost spikes, helping the Turkey to stabilize both producer and consumer prices even as the global trade problems continue. So, in conclusion, the Turkey's recent experience underscores how fast-moving digital finance, shifting geopolitics, climate-related food shocks, violated FDI inflows, and global supply chain disruptions intertwine to challenging both price stability and exchange rate management. Yet by embracing the simple, rule-based tools, real-time flow monitoring for emerging digital channels, transparent reserve management policies, climate indicator integration, predictable reform roadmaps for investors, and diversify the sourcing strategies, Turkey can break the circle of relentless swings. Above all, consistent communication and steadfast commitments to clear, data-driven rules will anchor the public and market expectations, fostering the reliance in an ever-evolving international monetary landscape. So that is all about our presentation. So thank you for your listening.